So our next presenter, he is the Chief Executive Officer of Growthpoint Properties. It's one of South Africa's largest real estate investment REITs, or real estate investment trusts, or REITs. He has been involved in banking and listed property for 25 years. His experience in takeovers, mergers and acquisitions, as well as transformation deals and capital raising. He is a chartered accountant who started his career with the marketing department of Estienne Durban Distribution, followed by roles in banking and property finance with Investec Private Bank. And in 2002, he joined Investec Property Group's property fund management business, which was then building its property funds under management, including Medboard Properties Limited and Growthpoint Properties Limited. He was appointed fund manager and executive director of Medboard, and later he went on to become executive director and group managing director of Growthpoint before being appointed chief executive of South Africa. He has been active in the leadership of the South African property industry, and he's a well-respected voice for the sector. He's currently chairman of the South African REIT Association, of which he's a long-standing member, having served on its exco and its chairman of its taxation and regulatory committee since inception, where he laid the groundwork for the country's REIT framework. Good on you there, Estienne. So he is past president of SAPOA and South African Property Owners Association, and he represented the industry in the property sector charter negotiations. His name is Estienne de Klerk, so welcome to you, Estienne. It's wonderful having you on the show, and we look forward to hearing from you. What are your insights? We've had our two economists now giving us not all good news, but there is light at the end of the tunnel. You right in the middle of the biggest REIT. Tell us what's going on in the real estate market. We all hear. Over to you, Etienne.
Thanks for that kind introduction. Morning, folks. Just for clarity, Neil, I specifically missed Davy and the other economists' lecture this morning. Unfortunately, I had other commitments, but the last time I listened to any of the economists, I didn't sleep for a week. It was so traumatic and negative. So the reality is that, you know, us guys in the property industry, sometimes it's good to stick your head in the sand and just forge ahead, you know. So I think the question that you guys have posed me this morning is to what the future holds. And after a couple of brandies and polishing that crystal ball as best possible, you know, we've obviously got a couple of insights that we can talk about this morning. I know that we're slightly over time, so I'll go a little bit quicker, just to ensure that there's enough time for the panel discussion and some of the questions. And what I'll cover is just, I'll touch a little bit on the three sort of major commercial real estate sectors: retail, office and industrial. Just a brief overview of hotels, hospitals and data centers. And then we can talk about some of the others around sustainability and electricity, municipal services, town planning, capital markets. And no property discussion today in South Africa. Will be filling out a little discussion on REITs. So if that's not what you signed on for in terms of the discussion, it's an opportune time to log off at this point, but off we go. So look, I think it's clear that the world's changed real estate. I don't think we in the real estate industry are naive to what has happened in that, you know, clearly we've been moaning about the economy now for the past 5 years. And if you overlay our experience with COVID into this whole mix, it's been a pretty tough couple of months for the industry, and couple of years for that matter. So generally, most of the trends in the real estate sector at this point indicates it's not the 7 wonderful fat years, but we're into those lean years. And I'm hoping we're at the end of the 7 lean years, and that this is the beginning of some kind of a recovery, whether it's V-shaped, U-shaped or K-shaped. We don't care, as long as there's some recovery that can assist the industry. That will be particularly helpful. But maybe to give you just some insights into, you know, some of the realities, is that, if we first look at the retail side, and I'll touch on demand and rental levels in all three of the sectors, maybe some of the trends and the varying experiences in the different sort of subsectors, as well as valuations in the investment market as well. I think the reality has has been a factor that generally in all three of the sectors we are seeing supply exceed demand. So if you look at retail specifically, we had a period of, I would say, 12 odd years where we've seen unprecedented development of retail facilities across the country. Now, some of those developments were in underserviced areas, so we've seen rural retail come up, and those actually in this period haven't been as materially impacted. In fact, I would argue that they probably have benefited from lockdown, because what's happened is people have moved out of the cities to their second homes in some of the rural areas, and on top of that, we've seen grants being increased, from a social perspective from government. And I'm sure there's quite a lot of PPE money floating around on top of that. And what we have seen is that clearly lockdown was devastating for the property industry. We quickly pulled together an industry group to deal with government, to help the industry through this period, and to deal with the retailers that effectively went into what was similar to a rental strike. And I think as a country, as a result of that, we've been able to get through it pretty quickly with very little legal intervention and legal implications. So industry put together what I would call a stimulus package, probably the most effective stimulus package presented in the economy, in that, very quickly, within 2 weeks, a guideline of relief was released publicly to the market, where the property industry kind of committed to helping tenants, and specifically the smaller ones, getting through this very, very difficult period of lockdown. And in this time, I think more or less, just per our rough calculations, the industry probably gave up roughly 5 to 8 billion rands worth of rental in the form of either straight discounts or in terms of deferred rentals on interest-free basis. So that really helped the industry avoid huge legal wrangles, but also saw the property market clearly take quite a knock, in this period. And coming through that, we're not exactly through it yet. So what we have seen is that collections on the retail side have remained difficult. As I've pointed out earlier, different retail has experienced this environment differently. So if you a Sandton City or one of the very large malls, the super regionals, footfall has dropped significantly, and that has been quite slow to come back. And specifically in your higher LSM areas, we've seen that those footfalls have been slower to return. What has been evident is in many of the residential areas, we've seen certainly footfalls back up 70 to 80% of what they were. And interestingly enough, the spending patterns have changed somewhat, in that we're seeing that people are going to shopping centers less, but their basket sizes are significantly larger. So in other words, risk mitigation, going to the shopping center slightly less often, but when we're there, we're making sure that we get everything that we need. I think, no discussion will go in retail will go, without a mention of EdCon. And I think in this time, the industry, I think, certainly has dodged a little bit of a bullet in a way, albeit in the short term, very painful, in that EdCon, has been predominantly sold. The two big components being the jet enterprise and then the Edgar stores. And I mean, a company like Growthpoint had over 88,000 square meters, which it had whittled down over a couple of years from 120, but it's still it's the largest retailer in the industry. And you know, to the extent that that rental would have gone to naught, it would have been particularly painful for the industry, on top of, you know, the challenges that we have been facing already. So I think there will be significant write-offs in the short term in terms of bad debts not being recovered out of the business rescue, but at least, you know, those new retailers have taken over and they're busy trading on those stores and continuing to pay rent. I think from a shopping pattern point of view, what we've seen is that, you know, there's also been a significant change in the spend. We're seeing more money being spent on home items and the home sector, and in fact electronics clearly had quite a good run through this period. You know, what has been quite difficult is the formal wear clothing, but what has proved a very good sector has clearly been all the value, and athletic wear has proven to be pretty strong. So those sectors, I think, will continue to do pretty handsomely through this period. But I think as people move back to work, then you might find a changing of spend. And I think also where that spend occurs will probably change going forward as people slowly but surely start moving back to what will be a slightly more normal sort of working environment. I think in terms of the small versus large retail, you know, as I said, the larger retailer offerings have proven to be a little bit more difficult. The sort of regional shopping center side, depending on where those shopping centers have been quite resilient, and trade has come back pretty quickly. On the valuation side, across the board, we are seeing significant write-downs. So if you go and look at the recent June results of some of the big REITs, and including the large retail REITs like Growthpoint, Hyprop, and Liberty 2 Degrees, as well as Resilient, and all of them have seen the valuations across the board being written down. I mean, Growthpoint's written down the valuations by 11.3%, so quite significantly. And in fact, I think we came out probably 6 to 8 months prior to our results to say, look, we thought that you know, valuations would come under pressure over the next couple of years, and you know, we think that reduction will be between 15 to 20%. So we're more or less halfway there, and I think you'll find over the next year that there could be a bit of weakness. And what's driving that? So it's certainly not the interest rate environment. The risk-free rates have been reasonably stable, but certainly it lies in the rental level. So what we have seen is that our renewals for the period until June as Growthpoint weakened by 6.2%, and that's been sort of a trend that we've seen coming now for a year. In fact, we started writing down our valuations a year ago already, and it was on the back of this weakness in rental, and it speaks to a bit of oversupply. So if we've seen major developments in retail across the country, and certainly in metropolitan areas, there's been what I would deem to be overdevelopment. Now, who's to blame for that? I think there's probably three kind of parties that you can maybe point the finger to. I think the first one would be the retailers themselves, because they commit to every guy with the bricks and the rights in the past 15 years. And I do see that that's probably going to stop in the short term. Clearly, the developers are driving that activity, but without those leases, they would not get any development off the ground. And then on top of that, you've got the financial institutions funding these developments that probably have contributed to the situation. So I do think that movie is probably over for the short term, and that we've still got a bit of retail to grow into. You know, you'll find certain retailers will have 4 or 5 stores within a 5 to 10 kilometer radius, which is absolutely bizarre. But, you know, given the weak planning sort of regime we have in South Africa, and at the time, the good access to capital and that very effective development ability in the country, you know, that really has given rise to this oversupply. So I think, broadly speaking, you know, the development space will slow down significantly, and that there will probably be more focus on, let's call it, refurbishment and upgrading of existing and repositioning shopping centers. If we look at the investment environment, so, you know, for the first time, there are some quality assets available for acquisition, but unfortunately the liquidity in the market is really poor, and that's right across all the sectors, other than potentially industrial, where there is a little bit of a different dynamic. You know, I do think that you'll see that the market won't be as liquid until there's some certainty on where rental levels will settle and where valuations settle. And then on top of that, you know, the financial institutions have to have some confidence in the market before they fund. And that combination is what's going to drive the investment markets in retail for the next couple of months. If we move swiftly on to industrial, you know, clearly the theme there is similar to online and retail, which we have seen grown from roughly, online and retail has gone from about 1.8%, where half of those were services like air tickets and movie tickets, etc. I think that trend has accelerated in the retail space to around about 5%, but remains quite small. And many of these online service providers aren't making profit, you know, so it's still the logistics is a major challenge for many of these providers. On the theme in office is clearly the work from home. As you can see, I'm sitting here at home, and you'd think for a property guy, I should be back in the office to promote how good the office is, and to be truthful, that is the case. Back on a rotating basis, but with that comes a whole bunch of challenges. So if you've got half the people working online, half the people working offline in the office, it creates quite a few challenges from on working together. And I really genuinely don't believe anybody running an operating business today will understand how difficult it is to run your operating business on a remote basis. So if you may be an asset manager or a stockbroker, where you know, working on the phone, buying and selling things, that's a slightly different scenario. But if you're running an operating business and you're having to manage people, you know, where there's collaborative effort, where there's training, where there's meetings that have to be held, then it becomes increasingly difficult if you've got a kind of half your crowd working from home and half your crowd working in the office. So I do believe over time that we'll see the office market fill up again. I think the bigger factor, to be honest, more than any of these kind of little short-term events, and not every little event is a trend, but certainly, you know, if you think about some of the trends like collaborative workspace, etc., for office, I do think that some of those have you know, run into some difficulty, and that corporate offices, albeit many of them not occupied, you know, specifically if you take reference to Sandton, where most of the financial institutions have given their staff instruction to not return to office before next year, you know, you're finding that the offices are predominantly empty, and that will probably in the short term be the event. But I think the trend will be that over time folks will move back to the offices, but there's going to be increasingly different pressures on real estate in this environment. So I think there will be a demand for more amenities at the offices that people had, for instance, at home. There might be a demand for more flexibility, which to be honest, I really don't know how that entirely plays out. So in a very weak environment, clearly you might find that many suppliers will want to give up space in the short term, or have quite a bit more flexibility in the short term. But over the long term, you do need security of tenure. So what we are finding is that the big corporates are still committing to leases, but that many sort of medium-sized and smaller corporates, given their financial uncertainties at the moment, are very, very hesitant to commit over the long term. So overall, what we are seeing is a shortening of the lease term, which probably will feed into valuations on top of the increased incentives that are being offered across the market. So, I mean, you know, vacancies in the office sector have risen to pushing 13% at this point, and certain nodes like Sandton, even the very top end space is freely available. So there's a lot of pressure, a lot of competition on rentals and incentives, and I think that will work into the valuations. And what we have seen is our renewals are for the period until June came in at just under 9% weaker, and as a result, we've seen roughly 8.9% reduction in our property portfolio valuations on the office side of things. So that trend, I think, is probably set in a line. In that we've already taken quite a lot of revaluation pain over the past 5 years in office, and there's been continually weakening rentals in specific nodes. But interestingly enough, there's still great demand for quality product. And I would actually argue from a valuation perspective, given where the yield environment has gone now, that if you've got a long lease with a quality covenant, a quality tenant, that those properties are probably worth more in this environment. So given the weaker environment, or the lower yield environment, the higher yield, growing yield from a long quality lease. So this could be a Discovery building or 144 Oxford with an Anglo lease. These leases, I think, will underpin the valuation. And in fact, you should actually probably see an uptick in valuation on these kind of investments. On the investment side, unfortunately, with the weakness in liquidity and certainly the big amount of uncertainty, you know, there aren't that many investors looking to bulk up in office at this point. So there is really quite a lack of liquidity, which I think makes it quite difficult for the valuation fraternity to get pricing points in terms of value. And you might see that in future, there might be a couple of portfolio transactions which will assist the industry going forward. On the development side, you know, if you've got 13, 14, 15% of the portfolio vacant, nobody should be developing. But as I mentioned, you know, there are tenants that want quality space, want new technology in buildings, and certainly the sustainability and technology aspects in office is increasingly, the green features is increasingly a dynamic, which I think is only going to accelerate and increase and become much more of a prevalent factor in the specific sector. So, you know, if you don't have it, those buildings will become redundant and will have to be refurbished, and that comes at quite a cost. And in fact, the cost is so material that it's after redeveloping these properties, often, you know, the sort of rental levels that you require might actually exceed market for a brand new development. So that's always going to be the pressure point from a development perspective. Of the three sectors, the industrial property sector certainly has sort of been the global darling. And, you know, the herd is often a little blind. And I must admit, I do find some of the valuations that we're seeing, certainly in the international realm, UK, some of the developed markets for industrial, are unbelievable, really, to be honest. It seems to defy gravity, the demand for the investment into industrial, and often the fundamentals don't really support that. So, you know, if you're buying assets at top prices, you know, where's the upside from there? And I think the one dynamic that many of the markets miss, or many of the investors miss, is that, yeah, you might be buying a 10-year lease, and I think that comes back to my point on a very good covenant over the long term being more valuable. You might buy a very long covenant, but what we are seeing with industrial, and certainly in the South African dynamic, we don't have those very long leases typically, and many of these tenants tend to hop to the new development as inflation on the lease tends to exceed the actual cost of development. And in this low interest rate environment, you can actually probably bring on some supply of new industrial at lower levels, which does leave existing property owners slightly exposed. But the reality is if you do your numbers, the investment case is a little bit more strained, given the fact that you've maybe got a 5 or 7 year lease, and then you might take a very, very large reversion as the tenant moves to the new building. So what we are seeing in industrial, though, is very, very important to have the right location, to have the right kind of product. And there is a rotation, not a growth in the market necessarily, but a rotation out of old product into newer product. And we have seen strong market performance on the back of that. And I think that probably will continue. And we will see a continued growth, I think, in the industrial space, specifically on logistics, because increasingly we're having to import as a country all our goods. And that has to go through the supply chain of logistics, and they do need those facilities to work effectively. On the rental side, certainly, we've seen pressure on the facilities, and for the past year, we saw our rentals come under pressure, just under 5% odd. As a result, we've seen even a weakening in industrial valuations at about 5% lower. And I think the biggest driver across all three sectors, other than the lower rentals, is also the prospect on growth going forward for the next couple of years. With our economy being weak, and I think the point being made is that in a weak economy, the demand is not there, and as a result, there isn't really a lot of pricing pressure, and generally the landlord's on the price taker in this specific environment. So for all three sectors, I think the environment with our economy is going to be a little bit difficult, and as a result, I think there is a little level of uncertainty. If we touch on just some of the other sectors briefly, hotels and hospitals. Now, you'd think, clearly in lockdown, hotels, and even as we sit here today, it's been a nightmare for that sector. And as a result, I think valuations across that sector have come under material pressure. Hopefully the market will open up, and we'll start seeing travel coming back, but it's going to take some time. So, we don't foresee that before next year. In the V&A, many of the facilities are now open and trading, but it's a slow grind. And as a result, though, that sector is still taking quite a bit of pain. One would think in a health crisis that hospitals would be the place to be from a property investment point of view. And interestingly enough, our hospital fund still delivered growth of 5.8% in distribution to the period of June, which is very different to any of the other sectors. So certainly doing better than some of the other sectors. But, even this sector, we pretty much have to provide most of our tenants with relief in this sector, given the fact that no elective surgery was allowed for a large component, and even post the lockdown regulations, what we've seen is that many people are in hospital because they're scared they might be sick, or they want to delay procedures best. Clearly, the broader economic environment, people have lost their jobs, etc., and as a result, some of their medical issues have to take a backseat. We are seeing, interestingly enough, as quite a strong sector is the data center market. And, we've been actually working on a couple of deals where there's still strong demand, as the demand for and the growth in data industry increases. I think that sector, certainly as a specific investment sector, will remain attractive and will be, at some point become of a critical mass that we see it as a defined specific. I think I briefly spoke about sustainability, but I think, it's such a big trend that I think, for the industry, it'll become absolutely essential for us to continue that path of ensuring that our properties are the most efficient they can possibly be. We certainly, as an industry, hoping to see the handling of the electricity industry into generation, distribution, and transmission, because that will allow property players to expand their generating capacity on roof, solar, etc., and be able to wield into the system. So we are natural offtake of our own capacity, but we are unable to wield through the system. And certainly, if you've got an office building that's not being used on the weekend, you'd like to use your power at your shopping center as an example. And at this stage, it's not really a possibility. No good property talk in South Africa won't go unfinished without giving our municipal friends a bit of a punch. This is probably one of the biggest threats with the economy to this. We have seen is municipal over the past 10 years way in excess. At the same time, seen away at expropriation without compensation, and effectively the municipalities are taking the rental to provide increasingly more services. So if there's no water in Cape Town, we're spending money to provide uninterrupted water. At most of our buildings, we've got uninterrupted power. To Woodmead interchange today, it wasn't the province with your tax money that built that. No, it was Growthpoint. So, that's not helpful. We don't get a return on those infrastructure investments, and ultimately it's really just not sustainable for the sector to carry that burden on top of all the other aspects that is coming to the sector. So loose town planning doesn't really help investment. So if you ensure that planning investors can take quite a long view on investing, and you'll see in the various cities if that happens, rather than this very loose, sprawling town planning where between, let's say, Beerspoort Dam, you get it all the way through, and with that huge burden on the municipality infrastructure, the ability to provide. So I think that is important to the market. Then maybe just on the debt capital markets and REITs and things. So, massive weakness in REITs. And in fact, the market is pricing in massive devaluations, huge weakness in rentals, much more than, in fact, the reality around is. And what we're also seeing is I think there's a huge expectation of very large, deeply discounted rights issue into the sector, and there's very little new money flowing into the sector given the economic sort of macro at this point. There's quite a lot of value to be had on the REIT point, and you have to believe some of the quality assets in the sector won't experience quite as traumatic experience as what the market is pricing into the shares. On the debt and capital markets, as I mentioned earlier, the banks are reasonably careful in this environment in funding significant projects or big acquisitions. If you don't know where the valuations are going to settle or where the rental levels are going to stabilize, I think it makes for the funders. On the bond market, what we have still seen is the big sort of counters have still had good support. Growthpoint has issued bonds right out this difficult, and we've received good support for the issue that we have done. So I do believe that the market in the pension industry still demand good investment product, and I think you might find a bit of a trend that because of the volatility in the listed sector, the unlisted sector might become quite attractive from an investment perspective, and it comes back to those long leases, those investable assets. So I do think for the South African investment market, that the institutions into the market and pick up some of these quality assets, and that will probably be held in the unlisted space. And as such, some of us have built fund management or asset management businesses to help manage these assets on their behalf. And we do see that as a trend going forward. So Neil, maybe in closing, it's all bad news, with lower interest rates and with a reducing fuel price, and some industries like government, obviously on the fall. Generally, I would argue that a weak economy isn't a trend, but the sort of lower interest rates a little bit.
Well, I think some of the good news, Estienne, is that your foot traffic at the V&A waterfront, one of your prime assets in Cape Town, seems to be picking up a little bit. And so I think that's certainly on a positive note. So maybe that is something, a trend that we hope to see increasing going forward.
It is a trend across most of the retail, that it's slowly but surely ticking upwards as people become more comfortable in going back to the shopping centres. In fact, I mentioned, in some of the residential areas, foot traffic was up 100% pretty much the month after lockdown, and that obviously has been a good trend.
Wonderful. Estienne, thank you very much. I'm now going to call our panelists. So you must stay on the line there, please, Estienne. I'm going to ask all our other panelists to please join, and we're going to move immediately into that panel discussion. And I just want to remind the audience out there that please post your questions. We've got a lot of questions for you already for our panelists, but please post those questions. And so, please, this is a great opportunity for you to interact and get some answers, get a way forward for the future.